All right. Budgeting. Budgeting is a kind of, can you all hear me?
Yes.
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 Okay, great. So we don't have to do the whole thing today. Chapter 9 is a little bit shorter, so we can do some of continue with chapter 8 maybe next week, and the kind of we can be flexible here. Chapter 8 is fairly large chapter, but don't get discouraged or feel like it's unmanageable or something like that. So so just hold on a second. Just go through it through your textbook and okay, I'm not going to go through this. So this is how our chapter looks like, and these are the portions of the chapter that we will cover and portions that we will skip. So as you can see here, we will skip some budgets like ending inventory budget and manufacturing overhead budget, direct labor budget. There's nothing really difficult in these budgets. They're just kind of a lot of details or something that, for example, you would just spend a lot of time, let's say on the exam, working through these, but they're just kind of simple numbers and easy to make mistakes, and but not necessarily anything that we haven't learned already or that would be kind of interesting or new to us. But we will go through our main budgets, and those of you who are working already will learn, and those of you who don't. But once you get into this, I mean, budget is a very important part of every business, right? So you have to know what budget is. So again, in this class, we are not just kind of learning a lot of theory and then that you will forget everything about later. You might forget about details, a lot of details, how to calculate overhead and things like that. But at least you know what overhead is. So here you might forget certain things about budget in terms of details, but at least you will know what budget is, how budget is created. And you've seen this before also, for example, maybe in your, if you had some to create some business plan or something in your marketing class, or maybe some management class or something, you had to deal with some kind of budget, right? You had to do some projections and things. And that's what budget is. Budget is a plan, right? So this is our business plan, basically, in numerical terms, financial terms. So when we say we will sell this much stuff this month or this year, we need to put it into financial terms somewhere, and we do it in our budget. So this is why we have, for example, first item on top is sales budget. So that will be our first item, sales budget. Again, I'm not going to go through every single budget here. I will just point out to important things for you to go through when you go through the lectures, narrated lectures. And so sales budget would be our first budget. Then we would create production budget. Production budget, right in the middle under sales budget, will tell us how many units we need to produce for this month, right? And we will learn soon that it's not the same number as the sales budget. Why not? Well, we will see in a second. Same thing then with direct materials budget. It will correspond to how many units we have to make. We are dealing here with manufacturing, right? But similar thing would apply, except we would not buy any materials if we are, merchandising company. We're just buying things, right? How many units do we have to buy for this month? So everything starts with our projections, for our sales. Then we need a cash budget, definitely. How much cash do we need this month? We cannot run out of cash. right? We have to pay bills, we have to pay for things. Then on the side here, on the right side, we have selling and administrative budget. That's kind of straightforward, simple. Maybe we could skip this too, but it's there. Okay, we know that we need something besides just, cost of goods sold over there, a portion. We need selling and admin budget as well. And then finally, on the bottom, we have budgeted income statement and budgeted balance sheet. So we'll get to this all the way at the end. And this is not the main focus in this class, other than when we are working, of course, through, like already from what was chapter 6, when we are working to figure out what our net operating income will be and things, then we are working with income statement. A balance sheet is definitely not focused in this class. This is managerial. Again, you know what balance sheet is. You cover this in basic financial accounting class. But just a budgeted balance sheet, we touch on this here. So again, you can stop me anytime. So this would be a sales budget. Again, I will go very quickly through these because they are covered in narrated lectures. So you see here, for example, budgeted sales. You have some units here, and then you're told selling price per unit is $10. Of course, you will just multiply number of these units by $10, and then you will get your budgeted sales in dollars that you're hoping to meet, right? This is your kind of projection, preparation. And this is for quarter ending June 30th, right? So this is for the second quarter, budget for the second quarter. So you get these amounts here. You multiply those units. You can see 20, 50, 30,000 by $10, and you get these amounts, total budget sales. So now you need to know this. This is, for example, very important. So you need to know how to collect your cash, right? You have to know how to collect your cash. You might be making a lot of sales, but if you're not collecting cash properly, you might go broke, right? Maybe not broke, but in the short term, you might experience difficulties, definitely with your, let's say, cash flow if you're not collecting cash properly. Also, money costs something, right? So why wouldn't you collect your cash the way you're supposed to collect? But in any case, you need to know how to collect cash. So this is an important topic, for example, here when it comes to sales budget. So you need to know how to collect your cash. This is always a question on the exam, how to collect cash. And I'm always puzzled why students, for example, get some of these basic kind of questions wrong. Now, this is kind of very, very basic here, but some questions are a little bit more, just have another tweak, additional month crossing or things, but still, you should be able to collect your cash. So, for example, you're always told the pattern, what the pattern of the cash collection is. So in this case, the pattern is what? 70% is collected in the month of sale. Well, that shouldn't be too hard to understand. You're collecting cash 70% in the month of sale, 25% collected in the month following the sale, and 5% is uncollectible, right? Sometimes it will say 50% cash or point of sale, 30% credit, etc. Right? So, I mean, if you're collecting it in the month of sale, that means you're collecting cash in that month, right? So, whatever the month you're looking at, 70% of those sales will be collected in the month of sale, and then 25% you will collect in the following month, and 5% will be uncollectible, meaning no collection. You will write it off. So in April, the March 31st account receivable balance of $30,000 will be collected in full. So $30,000 is coming in from March into April. Where in these three items here, 70, 25%, and 5%, where does these 30% belong? 30,000, 30,000, not 30%, 30,000 belong. Where does it belong?
5%.
25%.
Okay. Anybody else?
25%.
Well, in 25%, well, how can it be 5%? It says uncollectible. So 5% is not collectible, period. Not collectible, period. You will not collect it at all. So if you see here accounts receivable, that means that you will collect it, right? So now that's one item that you need to know what it means. Account receivable, you know what accounts receivable means. Somebody owes you money, right? Somebody owes you money. You will collect this eventually from somebody. So at the end of March 31st, you had some account receivable, meaning people owed you money. How much? $30,000. Well, is it part of these 70? Let me start drawing here. Is it part of these 70? It cannot be part of these 70. I mean, look, this is totally straightforward and fairly simple, but I'm just making a point how this is easy, but people still get it wrong, right? So it cannot be part of these 70. Why? Because these 70 include only money that is collected in March, right? In March. And if it's collected in March, then it's not account receivable anymore. It's not account receivable. It was collected already. Maybe it was account receivable at some point in March, but we don't care about it. We are now in April, right? So it was collected in March, these 70, definitely. So the only place that this can be is in these 25% collected in the month following sale. So these 30, so you see now, from these 30,000, actually, we can actually figure out how much the sales were in March, even though we don't have that number here. Even though we don't have that number, we can figure out what the sales were in March. How? How can we figure out what the sales were? Yes.
I think we have to go back on February.
No, February. It would be impossible to go to February because we have no information about February. All we have here is we don't even have information about April. The only information we have here is March. March 31st, account receivable. Well, information about April is that this balance of March 31st, account receivable. Okay, so this is a good point. For example, this is what we should do in these reviews. Like I should spend more time on things kind of detail that maybe I probably pointed this out in narrated lecture, but I don't have time forever in narrated lecture because again, you will get bored out of your mind. So we can spend more time on this, even though for some people might be bored here. They might say, why are we spending all this time on this? Just move on. But the point is then they can just watch narrated lectures, right? Because they're moving on fairly straightforward and quickly. So for those of you who are wondering why we are spending all this time on this now, this is why, because we have time on this, and so this is why we use these reviews. So we don't have any information about February. About April, the only information we have is what we actually have from March. So what were the sales in March? We are not told here what the sales were. But from this information, we can actually figure out what the sales were. How? Well, let's say sales in March, question mark, right? We don't know what they were. But we know that this X here, this X, consisted of what? Well, these sales or cash collections for these sales consisted of what? 70% of these sales, I should say 0.7, 70% was collected where? Of March sales.
In March.
70 it was collected in March. Very good. March. Now, 25% of March sales, which we are looking for here, X, 25% of March sales are collected when?
In April.
In April. Very good. In April. Very good.
April.
Yes. And 5% collected where?
Never.
Never. Very good. Never collected. Now, these three things will add up to something, right? They will add up to some X, right? And what information do we have? Do we have information for this 0.7? We don't. Do we have information for this? We don't. But we do have information for this. How much is this? $30,000. $30,000. So this portion of this X, portion of this X is equal to 0.25 of this X is equal to what? $30,000, right?
Yes.
Yes. Portion of this X, this 100%, 70, 25, 100%, this 100% X, portion of it, how much? 25% is equal to 30,000. Well, then this is easy now. Now we divide this 30,000 by 0.25, and these are our sales for March. How much is this? Well, 25, it should be 120, right? 4 times 30,000 should be $120,000. So you see how from this information here, you can actually figure out what the sales for March were, even though we don't need them here. It's not like, but this was all just to tell you how, well, a number of things. How, first of all, how you can get some information from information that you have, even though you don't have it. You don't have it directly given to you, but you can actually figure it out. Now, some of you are better with algebra and things than others, but you can definitely find information. But more importantly here, I wanted to make a point that it's kind of fairly simple, straightforward. You have to pay attention and say, when am I collecting this year? Well, 70% I'm collecting in March because that's the month of sale. Again, sometimes it's called cash, sometimes it's called month of sale, whatever. Then if it's cash, that means it's collected in that month because you receive cash right away at the point of sale. You sell somebody something, they give you cash. That's when you have collected it, boom, immediately. Now, if they give you credit card, you don't collect it, boom, right away, but it's kind of considered probably like cash. You might collect in 3 days or whatever. Now, if they pay you, like we're talking about these big operations, and then you learn this in 2101 accounting, if they pay you, like you have an agreement with them, you will pay me in 30 days, then you will collect it in the next month, right? Or within 30 days. They might actually pay you within 10 days, 5 days, whatever, but they have 30 days to pay you. So you will collect in, let's say, next month. So that will be in this category here, this 25%. Okay. So we spend quite some time on just one slide, but you need to know how to collect your cash. So instead of just running through problems, think about it. Think about it when you're working on a problem. Think about it. Okay. Okay, and you can see it here. These 30,000 from April, from March. I'm sorry, that came in to April. this becomes your beginning balance, right, in April, that you will collect now here. Well, I shouldn't call it beginning balance. I don't want to confuse it with other things later, but kind of beginning balance in, well, anyway, what you will collect. But this account receivable came in from March. So you will collect in this example, in this scenario, because you're collecting it just over 1 month, in a month of sale when you're collecting cash, boom, right away, and then on credit when you're collecting it, let's say in the following month. So these 30,000 you will collect in April, and then you will collect, how much were your sales for April before? Well, we'll calculate it on an earlier slide. It was 200,000, right? Well, so now you remember, you're just following pattern. 70% of 200,000 is 140, and you will collect those 70% of 200,000 in the month of sale. And you're selling stuff in April, so you will collect 140 in April. 25% you will collect when? In the following month, and the following month is May, and 25% of 200 is 50,000. So you will collect 50,000 in May, right? So for April, for example, it will not be just 140 because you also brought in 30,000 from March, so it will be 170. And then for May, then you go to May because, and 5%, remember, you're not collecting, so just forget about it. May, you will collect 50,000 from April sales, and then you will collect 70% of May sales. And May sales were 500,000, so 70 times 70% times 500 is 350, right? So that will add up to 400,000, etc. And then you keep moving on. And then you see here at the end, you have 905. Why do you have 905? If the sales for the quarter were 1 million, remember, sales for the quarter were 1 million. 1 million. Now, why do you have 905 here? Total cash collections.
Because 5% wasn't collected.
5%, yeah.
Very
Because
good. 5% was not collected. So that's how much? 5% of 1 million is 50,000, right? So, okay, so let's deduct 50,000. So that should be 950 then. So why do we have 905?
And then the second half of June, the 25% of June
It's
is
going to
not
be in
collected
July.
till the next quarter.
Excellent, excellent. Very good, beautiful. 25% here you did not collect, you see, right? Because that will be collected in July, right? So then 25% of 300,000 is what? For 75,000, what? No, 210. Yeah, 75,000, right? Huh? 25% is 75,000, I think, right?
Yeah, 75,000, yeah.
Yeah, so minus 75,000 collected in July. So that would give us what? 5 minus 8 is 7. And 875. So 875, but why do we have 905?
Because of the 30,000 that was carried over from March.
Excellent, excellent. You see, plus 30,000 is, so you actually end up with 905. Right, very good. So you see, you have to pay attention to details. It's just totally common sense and very straightforward. But you cannot miss things. So you have to pay attention to detail. What's going on? What's my pattern? And my pattern is basically, my pattern is given earlier. 70% in the month of say 25, you're just doing the same pattern. Now, sometimes it is a little bit more complicated when these payments or collections, I should say, we will work with payments in a second. When these collections go over more than 1 month, then it gets messy, right? But it's not messy if you keep everything nice and next to each other. You organize yourself in whichever way works for you. And then you say, okay, 1 million here total. Usually we don't work with but sometimes, yeah, like what are the total collections? So what would be the total collections, cash collections for this quarter? Well, it should be 1 million, but well, you would probably go differently about this. You would do it like it's done here. You would start with 30 that came in, then you would do 140 here plus 50 here for that moved in, or you would just simply say, I collected here 170 plus 400 for May and 335 for June. That's how you would probably do. That's how I would probably do it, because I would start with these 30 here, and then I would say, okay, I'm collecting 140 here, so this 170, and then what am I collecting in May? 50 plus 350, so etc. And then I would get these numbers also, and I would add up everything to 905, right? But I just wanted you to see how you check this, and you look at, well, because this is how you should be studying. You should be looking at this and saying, okay, why 905? Why not 950? Because 5% is only 50. Why not 950? Oh, but then, like someone said, oh, it's because 25% is collected in July. Okay, so that's another. But why not 875? Well, because 30 came in from March, so then that's 905. Okay.
How'd you start off with the 1 million?
Because that's what we were told originally, that sales for the quarter are $1 million. Sales for the quarter. I mean, you wouldn't need this for this problem. For example, if the question here is how much will you collect here, you would just follow this, what is on this slide. But we know that sales are 1 million because here they're 1 million. You see, sales are 1 million. Okay, and that's a sales budget. That's a sales budget. So again, sales budget is important. Let me see what's going on here on okay, nothing really in chat room. So that's sales budget. You need to know how to collect your cash. You need to know how to collect your cash. We will see more kind of a little bit more complicated problems in a second. The second budget that is very important, that is always asked, tested, is production budget. Production budget. What is production budget? Well, production budget tells us how many units we need to produce in this period, right? How many units we need to produce, and then also how much material do we need to buy. Those things are different from each other. How many units? Well, of course, material is based on units, but you will see in some problems that if you jump right away to materials based on sales, before figuring out units, you will get the wrong answer. Why? Because units will not always be the same. Units to make, to produce, will not always be the same as sales units. So let's quickly just look at sales units here. What did we say that our sales units are? 20,000, 50,000, and 30,000, right? April, May, and June. 20,000, 50,000, 30,000 units. So we need to produce these units, right? 20, 50, and 30. Those are our sales, projected sales. Now, do we really need to produce these 20, 30, and 50 units?
No,
Anybody looking at this chapter already? Why not?
because you might have some left over from the previous month.
Wonderful. This is beautiful. I would give you extra point, but I don't know who you are, so I cannot see the my
It's Mitchell Lewis.
Mitchell. Very good. Give yourself imaginary one extra point.
Thank you.
So-
I needed it.
So production budget, you might bring in some units from the previous month, right? From the inventory that you produced extra. important idea here because it will be important when calculating these things. And again, nothing difficult, but it gets messy when you're working with a couple of different months across different months. And also, it's easy to forget this, especially if you're asked for, question is asking you for materials for production, and then you jump straight into materials while basing it on sales. Well, it could happen to anybody. It could happen to me if I'm kind of careless and just I jump straight into materials. Let me calculate materials, and then you calculate based on sales. But those are not actually units that you need to produce. So put this as a note, important note, to always pay attention. What are the units I need to produce? And then go to materials. Now, if you're told these are the units you need to produce, what would be the materials for these units? Well, then you just based on those units, but different from sales units again. And again, this production budget is always tested, so important to know. So you are told, you are given instructions, you are given information that this company always wants ending inventory to be equal 20% of the following month's budgeted sales in units. Okay, so let's unpack this sentence. Let's go before we jump to the, okay, let's unpack this sentence. So this company wants ending inventory. So the inventory of units, finished units, at the end of the month to be equal to 20% of sales of the following month's budgeted. We are working in this chapter always with budgeted, right? 20% of the following month's budgeted sales in units. So what does this mean? Well, we have some sales in April, we have some sales in May, we have some sales in June, budgeted sales that we know, 20, 30, 20, 50, whatever the numbers were, 20, 50, 30, something like that. Why are we looking in the following month sales when we are producing these units? Because we want to have some safety cushion, right? We want to have some safety cushion. For those of you who are reading the book, you want to have some, I mean, look, now you've heard about Toyotas, Toyota sort of invented it, right? But just in time inventory and things. So we all know about this, but everybody's using it now, of course, because it minimizes your inventory cost, it's more efficient, etc. But you want some ending inventory just in case anything happens, let's say with your production, right? Something happens with your production. If you don't have anything to sell, something happens with your production. If you're just producing exactly what you are projecting to sell, which is usually the case actually now. Again, that's why everything is so tight, because everybody's producing just because all this technology makes it possible to pretty much know exactly what and to communicate to your suppliers and everybody else what your needs are at the very moment. And of course, the robotics and I mean all the technology that is making this stuff, it's kind of possible just to plug in a few numbers into a computer and say, let's produce whatever more units, and this is possible now. But let's say in the old days, for example, something breaks down in your production close to the end of the month. What are you going to sell next month if you have nothing to sell? Or I should say something breaks down at the beginning of your month. What are you going to sell if you have 0 units in your warehouse, in your inventory? You have nothing to sell. And you don't want to be in that situation. Why? Because then you're losing sales, right? Somebody else will sell it instead of you. So you want some ending inventory as kind of a safety precaution, as a cushion. And you will base this ending inventory for this month, let's say for April. You will base it on the following month's sales, because those are the sales that are relevant, right? Because you're producing this ending inventory for the following month anyway. So you want to base it on the following month sales. So this is unpacking this sentence. And how much? 20%. So you want to be looking at the next month and saying, how much are my budgeted sales? 20,000 units. Now, if you're looking in terms of units or you're looking in terms of dollars, doesn't matter, but you're looking at 20%, right? In this case, we're talking about units. So we're looking at 20% of units. So what were our sales, let's say? Let me see here. What were our sales again in May? Sales in May were 50,000. So you want to produce your stuff for April, but at the end of the month, of April, you want to have ending inventory of units to be equal to 20% of the following month, meaning May. If following month units are 50,000, you want to have 20%, which is what? 10,000 units. You want to have 10,000 units at the end of the month as a safety precaution, and those units will then go into May as beginning inventory of May. Everybody gets this?
Yes.
Okay. This is again why we are spending so much time on this here, because this is important. You will need to know this definitely for the exam production budget, right? Now, same thing as I asked you earlier. How would you figure out what the sales were in March? Well, you can also figure out what the April, for example, well, now we know, of course, what the April sales are, even though we are not told anywhere here, we know from before. But if on March 31st, you had 4,000 units at the end, how much were your April sales in units then budgeted? Well, we know they're 20,000, right? Because we are told, correct? We are told 20,000 units, correct?
Yes.
Yes, somebody, thank you. We are told 20, so we know this already, but if we weren't told, we didn't know this, can we figure it out? Yes, of course.
Yeah.
How? The same way as earlier. Well, we would say, well, what are our April sales? What are our April sales? Well, I don't know what the April sales are. But I know that 20% of those sales are 0.2. 20% of those sales are equal to what? 4,000 units. So if 20% of those sales are equal to 4,000 units, then total sales for April must be 5 times larger, right? If 20% is equal to 4,000, well, we would multiply this by 5 times, or simply divide 4,000 by 0.2, which is the same thing, and we would get 20,000 units. 20,000 units in April sales. Does everybody understand this?
Yes.
Yes.
Okay, very good, very good. So you see how you can see this, even though you don't have this, well, we know this, but you're not given this information on this slide, for example. You're not told 20,000 units. But you know that it's 20,000 because these 20% were based on those 20,000. And if they were based on those 20,000, and if we are told that these 20% are 4,000, then that means the total was 20. Okay, and here we have these budgeted sales. Again, 20, 50, 30 for a total of 100. So now you will work with this whichever way works for you, right? In this, I think this is a good format for most students. Some people like I like to put, for example, beginning inventory here on top, because they're kind of working in their mind, kind of in a chronological order, right? Because beginning inventory came from where?
From,
Previous month.
From the
Following month.
previous month, from the previous month. Mitchell, is this Mitchell?
Yes, it is.
Very good, Mitchell, excellent. So, because beginning inventory came from the previous month, so kind of it makes sense, kind of your mind is working in a chronological order, right? So you say here beginning inventory, plus then maybe you say sales, budgeted sales, and then you say here ending inventory, right? Now, the only thing with this, you have to be careful and remember that beginning inventory, you will have to deduct. Why deduct? That's why you have here less. Why deduct is because you had them already, so you don't need to produce them, right? So I will get to this on the next slide. So this equation is the same equation that we learned earlier, just kind of a little bit shuffled around, because we are not looking for the same thing as when we were looking for the cost of goods sold. So we said beginning inventory plus, let's say, additions minus ending inventory. Then we got whatever, whatever moved out, right, from work in process or cost of goods manufactured, and then move to finished goods and move to cost of goods sold. Well, in this case now, our ending inventory will have positive sign. Beginning inventory will have negative sign. So it's reversed situation. Why? Well, it's because we are looking for a different thing, right? Right now, we actually know what this number is. We will see it on the next slide. So right now, we actually know that these are our sales, budgeted sales. So we have an answer here, right? How we know it? Because it's a budget we are projecting. But we need to figure out how much we have to make, right? And to make things, we will deduct beginning inventory. Why? Because we had it already. It came from the previous month. We already produced it, but in the previous month as part of the ending inventory. But we will have to add ending inventory here. Let's say here, if we are doing it in chronological order, in this order here, because this will then cover for what? This will then cover for the following month, right? But that will be in a chronological order. In this case, this will become desired ending inventory will become. So you can work with this format here. It's totally great for most students. Why? Also because you started sales. It's a good thing to start with sales. Let's say, how much do I have to produce this month? Well, let me erase this for a second. Before you start complicating things, you say, how much do I have to produce for April? Well, the good idea would be to start with the budgeted sales. So you say, I'm going to produce 20. So you start with budgeted sales, 20. But then you ask yourself, okay, but I need to also produce something extra. For what? For May kind of safety thing, assurance. Okay, how much? 20% of May sales. So that will be desired ending inventory here, 20% of May sales. So that will be another what? 10,000, right? 10,000. And then you say, okay, so right now I need 30,000 units total for this month, for April. However, I had something at the beginning of April, which came in from March. So I don't actually need to produce it because I had those units. How much of those units did I have? Well, I had 4,000. We were told earlier I had 4,000. 4,000. So that's minus. You don't need to produce them. So 30 minus 4 will become 26. 26,000. And again, okay, we were told earlier that 4,000 came in from March, but we were not, you don't have to be told this information. Why? Because you're given here April sales 20, and if you're told 20%, you need to know that that's 4,000 here, right? That came in from March. So this is what will happen with some students. Some students will say, how do I calculate now my here less beginning inventory 4,000 number? How do I calculate it when I don't have March sales? I don't have March sales. You're not given, right? And why do you think this would happen? Why do you think that they would be feeling like I'm missing piece of information here? Less beginning inventory for April. I need March sales to figure out my April required production. Why would this happen?
They don't consider that the 20% of April is the ending inventory of the, March. So if you just calculate 20% of 20,000, it's gonna be 4,000.
Okay, that's excellent. But why would they think they're missing March sales to figure this out? I think you're onto something here, but I don't know. I don't read anybody's mind, but I'm kind of guessing here. So that's why I'm asking also. Why do you think would they would feel that they're missing information? They're missing. Why would they feel that they need March sales?
They just don't pay attention.
No, but I think it's related to what you tried earlier. Try again. Think about it. Inventory. Okay, somebody's saying inventory here in the chat. What do you mean by inventory?
I mean the beginning inventory, like you need to to get an understanding of what you had before you started.
Say it again.
So I was saying like you would need the beginning inventory to state what you had before the month started.
Okay, that doesn't help me, but somebody's saying here they could defer if March production failed to meet expectations. Okay, this is Ulukbek, I think, is saying this. Let me see again. No, Michael, I'm sorry. Ulukbek was saying inventory question mark. And then Michael was referring to March. If March production failed to meet expectations. Okay. So, but basically, so that's kind of a lot of too much thinking, actually. If March fails to meet expectations, and that's kind of real life thinking. But the bottom line is what Michael is saying is, I think the students are thinking they need to know March sales because they want to figure out March and then here include ending inventory for March, right? Kind of that makes sense to me. But they are not, what somebody said earlier, paying attention that this ending inventory has nothing to do with March. Well, it has to do with March in a sense, how much you need to produce in March. But the question is not how much you need to produce in March. The question is how much you need to produce in April. So the information that is relevant to you in terms of ending inventory is just these sales here of 20,000, because this ending inventory is based on those sales in April. But I think students get stuck on March because they feel they need this to figure out March. But you don't actually care about March. March is not the question here. The question is April, right? The only piece of information here that is coming from March is ending inventory, and that's based on April sales here. So you don't actually need much. You get my point?
Yes.
Yeah.
Yes.
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 Yes, very good, very good. So so again, just stay focused, right? Stay focused, pay attention, pay attention. Now, if you don't watch narrated lectures, and if you don't watch this review, and if you don't do anything, so whatever, then you might still do it, but you might then have trouble, for example, with this. Okay, so we can see these numbers here now. They are kind of fairly straightforward. You say 20,000, 10,000 you need to fulfill your needs for May, or ending inventory for April, basically, which will fulfill beginning inventory kind of safety for May based on May of 10,000. So total needs are 30 minus 4,000 in beginning inventory, that's 26 total. So you can see now, if you're looking for materials, which we will do in a second, and materials are basically the same procedure, so we don't need to spend that much time on materials. But you see, if you're basing your calculation on sales instead of production, you would get wrong number, right? Because if you say I need 3 pounds of materials, 5 pounds, let's make it 5 pounds, let's make it 10, easier. If you need 10 pounds of material for each unit, if you base 10 pounds on these 20,000 sales, you would get 200 pounds of material. But you actually don't need 20,000 units in April to produce. Those are your sales budgeted, but you need to produce 26. And why you need 26, we know why, because you need extra 10 to make for this ending inventory based on May, and May is, so your required production will always be higher if your following month sales are higher than this month, right? And same thing, your required production, kind of just in terms of when you look at numbers, you will see your required production will always be lower than your budgeted sales when your next month's production sales, I'm sorry, are lower than in the previous month. So for example, here your required production will be lower than 50,000. Lower than 50,000. Why? Because 10,000 will come in, but as part of the ending inventory, 10,000 will come in May as a beginning inventory, but ending inventory will be based on 30,000, so that will be 6,000, so that will be the difference, right? 10,000, 6,000. Same thing here, the difference is 10,000 here and 4,000 that came in. So you need to produce more. You need to produce more because you need to cover for the next month. Again, this is a totally simple example. It gets more complicated when you have to go across multiple months, but the procedure is the same. You have to keep track of things, right? So right now you have a required production of 26,000 units, and you will base your materials now, how much materials you need on these 26,000, not on 20. So you can see if you base it again on sales instead of production, you would get wrong answer for your let's say materials. And these 10,000 you see here in desired ending inventory for April will become beginning inventory for May. Now again, as I said, let me go to the next final slide. You know, a lot of you should use this format. if you feel comfortable with it. You know, a lot of you will like maybe chronological format because this might look confusing. We are talking about ending inventory here, but it comes before beginning inventory here in terms of chronology, right? Like going up and down like this. So a lot of you will like to put beginning inventory here, let's say, and then you will put sales, and then you will put ending inventory here that you need to produce, right? If that works for you, that's totally fine. You will get required production here, required production.
Can you just
So-
explain June?
I'm sorry?
Can you just explain the June?
Yes, I mean, it's explained already in the slide, but we will go over it. Or, I mean, some of you might say, as I said, you know, you might say with sales here, that's always a good idea to say, okay, these are my sales, 20,000. I will go, I have to produce 20,000, okay? Now you might say, in terms of chronology, then, you know, to make sense, you might say, but I don't need to make something that I had already, beginning inventory. So you might say here -4, but I need ending inventory of 10 here. So you might say ending inventory, I need +10. So you will end up with 26, right? So you can, you know, you organize it whichever way works for you, whichever way works for you. All of them are good. Okay, so June. Well, so in May, we know we need 50,000. We also need 6,000. Why? 20% of what? 30,000 here. That's 6,000. So you need to cover for those, for the ending inventory here for June. That's 20%, 6,000. So that gives you total needs of 56. But you had 10 coming in. These 10 came in here. So you don't actually need 56, you need 46, right? And as I said earlier, you see the 46 is lower than actually 50 budget sales. Why? Because you came in with 10, but you only need to cover for 6 for June, 20%, 30. And then you have June 30. I see why you're asking maybe why. Well, because we don't have July. I'm not sure if we're given July, but desired ending inventory of 5,000. Okay, how do we know this 5,000? Are we given July anywhere before? Let me see. Were we given July anywhere before? July.
I think no.
Yes.
Yes. Okay, we were given July here 25,000 all the way at the very beginning, long time ago. 25,000. But again, did we need to be told that, well, we would be told, let's say on the exam, or usually we are told, but do we need to be told that that July sales are 25,000? Can we figure it out, this 25,000 from this? Well, sometimes we are just given a number and told, okay, desired end inventory is 5,000, fine. Or July sales are 25,000, so you know it's 5,000. 20% of 25,000 is 5,000. But again, same like the thing earlier when we were going backward to March, we can go here forward and say, if the ending inventory here is 5,000, and if this is 20% of something, 20% of something, then what is that total something in July? Well, if 20% is 5, then July sales have to be 25, okay, in units, right? 25K. So this gives us 35 minus 6, these 6 that came in from the previous month production, for a total of 29, right? For a total of 29. So that's June. You should not memorize these things. This is why we are spending all of this time. I'm spending talking about, you know, kind of detail. The way I'm talking about the way to look at things, not what you need to memorize, right? And the way to look at this and recognize this and say, oh, okay, because then you understand it. You're just moving. Then it's just like a process, like any other. You're just moving through the process. It's easy. You're not memorizing. You're not memorizing things. You understand here that well, somebody started drilling, so I'm not sure if this affects anything, but you kind of use common sense and you say, well, I need to produce my sales 20,000 units, and then I need some ending inventory for the next month. How much? 20% based on the next month. So that's 10,000. Then, so that's total of 30. But I do not need to produce 4,000 because I had them already. So what you actually need to remember or memorize is just like, well, I need to remember to pay attention to what came in as the ending inventory for previous month, but became beginning inventory here. And what is it that I have to produce as ending inventory for the next month, or ending inventory now, I should say, beginning inventory for next month. Okay. This is the slide that kind of summarizes what I was just going through and explaining. This is a kind of a made-up T account on the right side, finished goods. This is kind of just a comparison of what we learned earlier in the class, in the chapter, and what you know already. This basic. So if this slide confuses anybody, just skip it, right? But this is what we learned earlier, right? What I said a second ago. Beginning inventory plus units finished or purchased minus ending inventory. We would get like cost of goods manufactured moving out to finished goods, or finished goods moving out to cost of goods sold, right? So we would figure out cost of goods sold, or again, cost of goods manufactured moving to, or raw materials, or whatever inventory account. But in this case now, in this chapter, we are not talking about the past. This was past earlier. We were looking into past. So we had this, and we had this, and we had this, and we knew this, and we were looking for this, right? So that was past. But now in this chapter, we have budget. We are talking about the budget. We are looking into the future, and we are projecting these sales. So we actually know this already. We are projecting these sales, right? So we know them, 1,000, let's say. But we are looking how much we need to produce or purchase here. And we have beginning inventory because we know beginning inventory 20%. And we know ending inventory here because we're also basing it 20% on some budgeted sales. So what we don't know is we don't know how much to make or produce. So that's why the signs are just switched around, plus and minus here, and plus and minus here. And again, I wouldn't recommend memorizing this, but actually you don't need to worry about these equations at all. You just use, as I said, common sense. Just common sense in terms of remembering, well, I need to deal with these units, plus I need to produce some extra units for next month as a safety, but I need to deduct units that came in from the previous period. Okay, so take a look at this through I mean, we are spending quite a bit of time on just these, because these are always tested, and these are kind of details that give students trouble. Now, of course, you have to work through this, through problems. You cannot just say, now, I get it, I understand, and that's it, forget about it. Because it gets messy when you start working on it, so you need to work on it. I'm not going to go through materials. It's the same procedure with materials, same procedure. You're given some ending inventory safety to have in terms of materials, in terms something happens with your production, or you're given how much materials per unit. You're told that inventory has to be 10% just in case, safety again, and then you're told how much material is per pound. So you can imagine that this gets a little bit kind of messy when you start all the calculation. It's easy to make mistakes. But if you're going step by step and you're comfortable and you practice problems and then it's not a big deal. Okay, and again, procedure is the same. So I will leave you to go through direct materials budget on your own. So this covers already sales budget, production budget, direct materials, but they're always all tested. So you need to know this. So far, you need to know sales budget. You need to know how to collect your cash. You need to know how to collect your sales, cash, credit, everything, right? And production budget, you need to know how to figure out what your units are, production units, which are different from sales units most of the time, unless the next month is the same, the same sales like the month you're looking for, then the units will be different. Production units, and you need to know how to handle material for those units. Selling and admin expense budget is kind of just straightforward. I mean, what's going on here? Fixed selling and admin expenses, you need to pay attention what is fixed, what is variable. You know this already, so there's nothing new here, really. Another new thing or item is depreciation here that you need to pay attention to. So if something is depreciation, you know that it doesn't involve cash, right? So you need to deduct it from your cash outflows, because we are talking about here cash, sales and admin expense or cash budget. So so you need to, how much cash do you need for these expenses? Well, if something is depreciation 10%, it's an expense. It's definitely an expense, but does it affect your cash? No. So you would deduct it basically from the total. So that's something to pay attention to. And again, you already know, you're comfortable with, you have to pay attention what is fixed, what is variable. So this would be, for example, selling an admin budget. Let's go through the whole thing. So you have some, in April, for example, you have some budgeted sales, you have 20,000, and then you have some variable sales and admin expense of 50 cents per unit. So that would add up to 10,000 here, right? And then you have some fixed expenses. S&A expenses 70. That's total of 80. So your total sales and admin expenses are 80,000. Now, if this is the question, what are your total sales and admin expenses? Then this is the answer, 80,000. But if the question, what is your cash sales and admin expenses that you need for sales and admin cash expenses? Well, it's actually 70, right? Not 80. Why? Because 10,000 of these 80, 10,000 is depreciation. It's a non-cash expense. So that's the only thing here in the sales and admin. Other than that, you're familiar with all of this, all the rest. Something is fixed, something is variable. You need to add them up. You need to differentiate them, which you had to do for the midterm. Differentiate sales and admin expenses from production expenses, cost of goods expenses, for example. So cost of goods sold. So you need to pay attention in case that's a type of a question. You need to pay attention what to include into sales and admin expenses, right? But it's fairly obvious most of the time, like straightforward. A lot of questions on the midterm were like that, just kind of very straightforward, very basic. So that's the selling and admin budget. And then we have cash budget. Cash budget. Let me see how many people are still here. Okay. Numbers dropping. Cash budget, you need to know cash budget. Again, also very kind of straightforward, very very common sense, but just go through exercises. And so we get some here some additional information. This is important piece of information. How much is our line of credit? What minimum cash balance do we need at the end of each month? This assumption will be in most of our problems, that we borrow things on the first day of the period and repay loans on the last day of period. But there's no here compounding things, continuously compounding, maybe I should say. You know, like we don't need to worry, well, we bought this on the 15th, how much interest actually is this, or on the 20th or something like that. We always assume that we borrowed on day one and we pay off on the last day when we have the money to pay off the balance or interest. Or this is dividend that is paid. Okay, so this is given to us, right? But these are important these are kind of policies, right, that are important to us. And this is just a beginning cash balance. So we go to, for example, next slide. Okay, so we see April here. So this is something that we have from earlier. For example, we would get these numbers. A lot of these numbers we get from different slides, or some of them are included, some not. But we don't care about them necessarily, except what we care about to calculate actually. Because a lot of these numbers, like, you know, again, we are given from different places. So cash collections, we would know actually that in April we would collect $170,000. We actually figured this out early. And if we started the month with 40, so actually we have cash of 210 available, right? Now we get a bunch of expenses, materials 40,000, 15,000 from labor, manufacturing 56, which we didn't calculate, but we know 40,000 from materials budget. But these other we are given, or I should say I skipped them, but you're given 1556. Selling and admin, we just calculated 70. We need 70,000 cash, and then dividend is 49,000. We are told, right? So we have total disbursements of 230, but we have only 210, right? So we are short $20,000. So we need to borrow. We need to borrow money. How much can we borrow? We can borrow, I think, up to 75 or something like that, was an earlier slide, at 16% interest, right? Annually, 16% interest. I think it's annual. So how much do we want to borrow here? How much do we want to borrow? The ending cash balance has to be 30,000. That's what we are told. This is our policy. We need to have 30,000 at the end of each month. So how much do we need to borrow? $30,000 only? $20,000 only?
No, 50,000.
50,000. Very good. If we borrow 20,000 only to cover this difference of 210 and 230, then we will cover for our cash, fine, but we will have balance of 0 here, right? So that's not good, because we don't want balance 0. We want balance of 30. So we need to add this 30 to this 20. So we will have 50,000 in borrowing. We will need to borrow 50,000. So we will borrow these 50,000 here, and we will end up with 30,000. And these 30,000 will become now, these 30,000 will become a new balance here in May, beginning balance in May, right? And then we'll go through the same thing here, la, 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 la. Now here we end up with, we have cash of 430, but our expenses are 400. That's the difference of 30. Can we repay any of our balance? we cannot. If we repay any of our balance of these 50,000, we would want to repay as soon as we have money, because then we don't pay for interest, right? But we cannot repay for any of these 50,000, because if we pay for anything, then we would be less than 30 here. So we want to stay with 30. So we will do nothing. We will not repay anything here. And then in June, we will start again with 30, and then we will have 365 here. Our expenses will be 270. So we will have 95,000 extra cash. So now we can repay full 50,000 here. And we can also repay our interest. And interest again is 16% per year, which means 4% per quarter. And this is 4% here per quarter, right? And we said we assume that we borrowed here on April 1st, and we assume that we repay here on June 30th. Why? Well, this is just an assumption here. We borrow at the beginning and we pay at the end of the period when we are paying. So we will not assume that we paid here, let's say on repaid here on June 20th, 10th, or whatever. This would make our calculation more complicated. Here we assume just that we are borrowing at the beginning and paying interest and principal at the end of June when we have money. And we have 95,000, so we will repay 50 here, and 4% of 50,000 is 2,000, so we will pay 2,000 also, so that will be 52,000, and this will leave us with a balance of 43,000. Now, if we had some money, you know, if we had some let's say, if we had, instead of 30,000 here balance in May, if we had, let's say, 60,000 balance, then we would repay a portion of these 50,000, right? We would repay a portion of these 50,000. We would still leave 30,000 at the end of the period. We must have 30,000. And then the difference, the other 30,000, we would use to repay portion of this principal and also interest on that principal, right? So that would be again a little bit, but usually problems are not complicated like that. So you would have to figure out, well, how much can I repay? $30,000. 30, you have 30K. How much can I repay in terms of principal plus interest on that principal for a total to be equal to 30,000? So that's usually we don't ask those questions. And then in that case, what would be the interest? Well, the interest on that part of the principal that you're repaying would be borrowed here and repaid when? Repaid here, right? At the end of May 31st. Everybody good with this? Everybody understands this?
Yes.
Okay. But again, usually this is not asked because again, it just makes calculation more complicated unnecessarily. But in case you need, the important thing is to understand that your instructions are most of the time, if not always, you're beginning borrowing at the beginning and paying at the end. So in that case, the end would be May 31st, because that's when you're paying portion of the principal off and paying for the interest. And this is a cash budget done. Cash budget done, right? Okay, let's let me see. Okay, let's finish this and then we'll do some exercise next time. We'll do some exercise next time. So that's a cash budget. Income statement Income statement, we have some, I'm sorry, I skipped income statement. Income statement is here. Just one slide, straightforward. These are sales we know for the quarter, $1 million. Cost of goods sold, we did not calculate, but we get this number from another place, 499. Gross margin is 501. Selling and other expense at 260. We have it from the expense budget. Remember, these are the expenses. This is not cash. These are the expenses in the sales and budget. So this is not, this does not affect our cash calculation when we said pay attention to maybe non-cash expenses like depreciation thing. Operating income is 241. Interest expense is 2,000. So net income is 239. Okay. Now, one thing about this income statement here is I believe it does not include a minor point, kind of, but just in case something like this is on the exam. This income statement does not include that 5% of bad debt, right, or uncollectible amount. So, for example, that would be also deducted from this income statement because you would not collect clearly those 5%. So, but actually, I mean, this is not a cash flow statement. So this is an income statement. In case, well, in the income statement, we would deduct those 5%. It would reduce our income. So in case this is, you see something on homework or somewhere, practice questions, so you pay attention to this and you say, okay, I would have to deduct 5%. Remember 50,000 from this 1 million, 5% in uncollectible, right? So this would actually be lower for 50,000. Yeah. Kind of a minor thing, but just in case. And then we have budget balance sheet. Balance sheet, this is just information about balance sheet, land, common stock, retained earnings, equipment. So important just piece of information is the retained earnings. You might be asked to prepare a balance sheet and you need to know your income, which is 239. And then you get to the balance sheet now. Now you will see some examples. How you can go, from one direction to the other to figure out what the balance sheet looks like. I mean, this is 2101, so we don't put a lot of emphasis on this in this class, just in case there's a question or two or, about the balance sheet. I mean, you remember that these two items will be the same, right? Because total assets have to be equal to liabilities and stockholders' equity. So once you know this, you will see in one of the exercises, you can go back and forth and plug in things, figure out missing items, because you know that these two numbers are equal, so they have to match. After this, you're just using those numbers that you have already. So finished goods, land, equipment, we are told a lot of this stuff. So we end up with 564, 550. Now in the liabilities and stockholders' equity side, we get 28,400 here in accounts payable. We know this from our payables for materials. And then common stock, we're told is 200. And then retained earnings are now 336,150. How did we get 336,150? When earlier it was, I think, 100 and something. Well, we got it because retained earnings were 146,150. Now they are 336,150. Why? Because we added our net income to those 146,150, and we also deducted 49,000 for dividends, right? So we ended up with 336,150. Again, balance sheet, if there's a question or two here or there, But otherwise, I mean, I wouldn't spend too much time having headache over this. This is kind of more 2101 material, but we have to cover it. It's part of this class, part of the budget balance sheet. So you would know you would end up with 336,150 in retained earnings, and then this would help you figure out, well, let's say these 564, 550, or you can go in different direction. We will see, or you will see it in an exercise. So this is a budget, fairly large kind of fairly large, and we will see. We might do some exercise or not. I don't know, but we covered because they're covered in narrated exercise, definitely on Blackboard. Let me. Let me see what's going on here. Stop sharing.